Welcome into episode 10 of Charts and Checks, the podcast that takes three, well, this time four, of your favorite stocks and analyzes them from a fundamental, financial, and technical perspective. This week, Alphabet, Amzn, Salesforce, and Figma are on the docket. We are going to aim for a 4 stocks in 40 minutes challenge. And by we, I'm referring to us, your host, Alvaro of the Bilingual Stock Market channel, and myself, the Gorilla with Glasses, Don Foyani. Before we jump right into Alphabet, is there anything on your mind you want to talk about right now, Alvaro?
I'm curious about the fact of, us being able to cover 4 stocks in 40 minutes. It's a challenge.
Sure.
I'm excited.
It will be.
Let's do it.
Will be. Got my eyes on the clock here.
There you go.
Officially a minute in. And yeah, we can go ahead and start right with Google. Obviously, stock is at a fresh all-time high due to the recent developments from the court ruling that cleared up a few overhangs. The first being that Chrome is no longer going to be forced to be removed from their ecosystem. That's not a threat. The second is that we also now
Which ended up being good news for Apple, by the way.
Yes, it's about to get to that. It also means that, well, this also came out in relation to that order. Apple is not going to have to remove Google as the default browser. That practice in and of itself, as long as it is renegotiated on a yearly basis, is no longer being viewed as monopolistic. When you take these two developments and combine it with their last quarter, where the search results were robust, you need to reevaluate Alphabet's competitive position. I think you can still make a good case that AI searches, including the ones from their own Gemini, will siphon queries from traditional search over time. But what changed with this ruling is that you can no longer make the case that the money printer masquerading as the traditional advertising oligarchy that Google shares with Meta is at risk.
Which is a search engine.
Yeah. So all that means to me is that there was this concern that Alphabet was going to lose the capability to keep up in the AI spending race. That concern is now diminished. So you got a cleaner story, and the valuation needed to re-rate higher to reflect that new situation. That's how I explain it.
What about the bear case? That the search engine is in jeopardy because of, ChatGPT and Perplexity and stuff like that.
I think you can still make a fair case that eventually you will get a siphoning off of traditional search. There'll be some cannibalization, and there will also be some competitive risks. But now that Google gets to keep Chrome, and now that Google can remain the default search browser on Apple devices, that risk is no longer hyper compressed in a short period of time. And I think the market is making a bet that between the success at Waymo, the success with YouTube TV that has a great partnership with the NFL, the money printer, the main core business of advertising at Google is still in a very strong position and is going to allow them to invest in AI similarly.
Can you see my screen? Yeah,
yes.
You can see here. So
yes.
Yeah. So Google search revenue represents most of Google's revenue. So this is the bear case. So take a look. In Q2 of this year, the revenue that came from Google search was $54.19 billion.
Yeah,
you can see.
Yeah.
You can see the revenue, broken down here. YouTube, 9.8 billion. Google Network, 7.3 billion. Subscriptions, 11.2 billion. Google Cloud, 13.6 billion. So definitely, Google search is very important for the business. As of now, this could change, right? But as of now, it is what it is. Do you think that the cloud segment of the business can, at some point, be larger than Google search?
Of course. Oh, larger than Google search? I'm not sure, but I think that when you look at how their AI business is going to look, AI is going to replace some of this search revenue. And if you take into account the fact that YouTube is looking like the second best streamer on the planet to Netflix, and with the huge market that could be waiting in autonomous vehicles through Waymo, given the stock is at a new all-time high, I think the market is taking all of these developments and viewing it through the lens that Google is going to be fine on the other side.
Take a look at that revenue growth. Very impressive. I mean, we're talking about a company that has a market cap of how much? This is a $2.5 trillion market cap company. Take a look at that. Impressive.
Yeah. Very
14% year-over-year revenue growth. I mean, what's not to like about Google? Take a look at the net income. $19 billion of net income in Q2 of this year. Very impressive.
No, no doubt.
20% net income growth year over year. I mean, and don't get me started with the multiples.
Right.
Take a look. P ratio of 24. It trades at 22.
Forward, 22 forward.
22 times forward earnings. I mean,
it may be the cheapest of the
I mean, I have to be very honest with you, bro. I don't understand the Google bears. I don't understand
Google
this.
bears?
This is I mean the bears of Google. So the people that are making a bear case, like if no one in the future, I don't know, 2 or 3 years out, will be using Google search.
Listen,
So I don't see this business model in jeopardy. At least, I mean, maybe because I am still using, I am still using Google search. I don't know. Maybe this is my personal point of view, I guess. But I cannot. I don't know what's not to like about Google. To be honest,
Alvaro, I don't know many people that have completely taken Google search out of their life. And for whatever it's worth, I still see people's emails at AOL and at Yahoo. So there are certainly going to be a subsegment of the population that never gets rid of their traditional search as part of their process. Moreover, there's a segment of people. This reminds me a little bit of the cable cutting narrative.
Correct.
There are just going to be some people that never cut the cable, and they're never going to go to streaming. Eventually, the bleeding stops. I don't think Google's even seen a little bit of that bleeding. I think the issue was that when we were coming out of April, there was a lot of, we had that Eddie Q from Apple say that search was going down on the Apple platform. But then the quarter showed you that it wasn't representative of the whole. I think the story would look a lot different if Google actually showed weakness in traditional search. But until then, the money printer's printing, they can keep up NAI, and all their business segments are working. So you're totally right. What's not to love at this point?
Yeah, correct. Take a look at the revenue growth expectations by analysts. 2027, 11%. 2028, 11%. 2029, 11%. So, I mean, I don't see any disruption affecting in a negative way Google eventually. At least most of the analysts that are covering the stock are expecting this company to keep growing at least 10 or 11% from a revenue standpoint in the upcoming years. I mean, I'm not gonna say that I am necessarily a buyer of Google at $229 or something like that.
$232 it closed today.
Correct. But I will be a buyer of the dip, to be honest with you.
I think, and I hope there is a dip that comes here. I'm just gonna quickly share, if I can.
Yeah, I didn't go over the technical chart because it is pretty. I mean, it is at an all-time highs.
So this might be the best non-earnings move for Google in like 20 years. So
people got extremely bearish when this stock went down to $150, $145. Unbelievable.
I am in the camp of gaps tend to get filled, but when you have a forward multiple of 21, I don't know if you necessarily need to fill the whole thing or fill it at all.
Yeah.
So I'm super optimistic on Google for anyone that's stuck through crazy.
Is this the cheapest stock out of the Magnificent Seven? It gotta be.
I kind of made that comment to you earlier. I wasn't sure. I think at 21 forward, it has to be bottom 2, right? The only other one I could think of is Meta. I know correct. Amazon trades at 30, Nvidia's at 30, Microsoft I think is also 30. I think 5 of them trade at 30 between 30 and 35. Excuse me. I think that
Meta is trading at 25 forward earnings.
Okay, so that it's probably in that case Google's
it's
probably
the cheapest. Yeah, it's the cheapest. Yeah, no doubt about it. Yeah.
All right, 1 minute to spare. Let's move on to Amazon, shall we?
There you go. 100%. Let's go over Amazon.
So you mentioned that,
I day traded Amazon today, by the way.
All right, walk us through that. That might be cool to show. You want to show us a little bit of that or no?
So yeah, I told the guys in Discord that I was thinking about starting a position on Amazon. So let me pull up the technical chart, and there I go. So okay, this is Google. Let me pull up Amazon here. It got upgraded today, and we got an unusual call option alert that was posted in Discord. Correct. So I started this position above 232.70. Take a look. It is a previous level of resistance. So Amazon failed on 3 occasions. This was back in mid-August and failed once again at $232.70 to $132.50 in late August. So the second this previous resistance started to act as support, and above all the moving averages, I decided to purchase 100 shares. I closed the position quickly. I made $110 or $120 or something like that, because tomorrow we have the jobs report, and you never know, right? If we happen to see volatility picking up pre-market. But yeah, I mean, this technical chart looks fantastic. Take a look. So I wouldn't be surprised in regular market conditions seeing Amazon going up to all-time highs, $242. As long as the bulls can consolidate above $232.50, previous level of resistance that I just pointed out. So what do you think of Amazon here? This is a stock that trades at higher multiples relative to Google and Meta, but from a historical standpoint, it is trading at a discount.
Yeah, no, let me go ahead and take over the screen here. So
okay, 100%.
Something interesting is that we had that earnings report, and people that we now knew absolutely nothing said it was a bad report. It caught support right at the 150 day, little check mark there.
I think that the metric that disappointed, quote unquote, disappointed the markets was the growth on the cloud segment, right? And AWS, I think.
AWS. There
Correct.
was a theory that because it only grew, I think, 19% and Azure grew 39%, that Azure was taking market share from Amazon.
Correct.
I disagree with that thesis. I have a feeling that Azure with OpenAI and from all of the, we'll call them data checkpoints and people in the industry that I talk with, Azure has a consumption AI model. AWS just isn't there yet. So Azure was able to bill more AI related expenses to their customers than AWS was, but that's a conversation for another day. The point is, with today's action, you've refilled the gap up to where Amazon traded prior to the so-called bad quarter, which means that the market has taken a couple of weeks and has now decided that perhaps that quarter really wasn't worth selling.
Yeah, agreed. So you agree with me on the fact that we might be seeing all-time highs?
Yeah, I think if this thing breaks above where it is right now, and I had it on the chart earlier, 240 is the all-time high. You get through there, 250, 260, name your price. There's no sellers. There's no one with stock of Amazon at $250.
No overhead supply. That is correct. Yeah, that's a very good comment.
The only other thing worth mentioning, which I think maybe is what caused the unusual.
I have a curveball for here. Okay, let me know. No, go ahead. Sorry.
Yeah.
I have a curveball for you. Okay.
All right. Project Kuiper is their low Earth satellite project. It landed its first internet deal with an airline thanks to JetBlue. That could have helped boost the stock. It's a business that probably wasn't making any money, let alone revenue. So this is a big development for that low Earth satellite project. And there was also some rumbling that Amazon is thinking about tightening restrictions on shared Prime accounts. So Amazon could be in the midst of a password sharing crackdown or membership crackdown vis-a-vis Netflix and Costco, which would be another way to increase the number of Prime subscribers, another way to increase the recurring revenue that Amazon generates, which you'll pay a higher multiple for.
Correct. And this is still a growth stock, no doubt about it. I have a question for you. Online sales still represents the vast majority of Amazon's revenue. So in Q2 of 2025, which is the last quarter that they reported, online sales were $61.4 billion. And take a look at the revenue that came from AWS, $30.8 billion. But you can tell, do you see the segment that says AWS? Take a look at how the revenue that comes from AWS keeps going up and up and up on a sequential basis. So my question, since the largest net income that this company makes comes from AWS, do you think that over time, I don't know, maybe many years down the road, the revenue that comes from AWS could be larger relative to the revenue that comes from online sales? Because that is the real bull case. Because, online sales is a logistic business, which is very, capital intensive. Right. So this is the real bull case in the case of Amazon. So I'm thinking that as long as the revenue that comes from AWS keeps growing, and maybe eventually, I don't have a crystal ball, but maybe later on down the road, if that revenue is greater than the revenue that comes from online sales, I mean, the net income of this company is going to skyrocket, bro. What do you think about this? What's your take on this?
I love your take. I don't know. Here's what I'll say first before I answer your question. I think when you have a business like Amazon and a business like Google, you can start talking about some of the parts. Right now, the fact that AWS is minting or hit 30 billion, was it, in revenue, is important.
Oh, sorry. Yeah, let me go back. Yeah, 30. It did $30.8 billion.
30.8 billion, and the first party sales do 61 billion. The way I view it is that the more AWS sales the company has, the higher the multiple the overall company will get.
100%. But take a look at this. Take a look at this detail. So, the profit margin. So the average profit margin for a pure, tech company, usually oscillates between 20 and 30%. In the case of Amazon,
10% is too low. Yes.
Correct. Exactly. Yeah. So, if the revenue that comes from AWS keeps growing, which I think might be the case, the profit. Yeah. So the profit margin is going to go up.
Yeah.
Take a look at the net income that this company made, in Q2 of this year, which is the last quarter that they reported, $18.16 billion out of $167 billion. So if this net income keeps going up, especially from a percentage standpoint, take a look at the multiples. So let me pull it up here quickly. Let me see. Let me go over here. Stock analysis. So take a look at this. The ratios. So this company trades at a forward P ratio. What is it at?
30 times?
34.
34, yeah.
But here's the deal. Look, it's the lowest forward P ratio ever for this company.
Amazon's cheap relative to itself, without a doubt. And I think
from a historical standpoint, no doubt about it. This is a cheap stock. Unless you have a bird case against the company. I don't know. It's super mega recession or whatever it is. I don't know.
You're allowed to be bearish based on valuation if you'd like, but you need to have a thesis that includes a catalyst that puts scrutiny on that valuation. You can be like, for example, the best example of this is Apple. Apple is traded at 30-something times forward for the past 4 or 5 years, only growing earnings at 10%. 7%. It's not super compelling. But until something actually happens to change the state of play surrounding Apple's business, you shouldn't expect the multiple to just contract. Because the market has decided Apple is a 30 times forward earnings company. So until something changes fundamentally with Apple, I don't see why that multiple is going to move.
Yeah, but we have a growth issue in the case of Apple, which is not the case in the case of Amazon.
Things.
So if you point out, okay, go ahead.
Real quick, sorry, I just want to answer because I said I would answer it, but I will. I think the only way that AWS ends up making more money than the
online sales,
thank you, is if the economy shifts. I view that difference as a difference in economy, because there are still people buying a lot of things. If we continue this shift as an economy that is buying digital goods or buying software more than we are buying physical goods, then eventually AWS's revenue will reflect that, and so will a decline in online sales.
Correct. Eventually.
Like one day. I don't see it happening in even like maybe in 2030 people start talking about it, and we're just not quite there yet. But I don't see it happening in the next couple of years.
Correct. But let's agree on the fact that if this company is trading at a forward P ratio of 34 with a profit margin of 10%, if that profit margin goes up to 15, 20, 25, 30%, this multiple is going to expand more likely than not.
Well,
in regular market conditions, let's just put it that way. So
I agree. And unless a 34 multiple is anticipating profit margin growth from AWS.
Yeah. I don't think it is, but
no. Like, here's the thing. If it goes from 34 to 36 and they have more profit,
but you have people paying higher. Correct. But you have people paying a forward P of 34 with a profit margin of 10%. That profit margin goes up to 20, 25%. And I think that people would be willing to pay a forward of, I don't know, maybe 40, 45.
I'm not going to fight with you on this. You're right. You're right.
We got to move on.
Yeah. Yeah.
until the next talk. So what's
right.
coming next?
We
20
can talk
minutes.
about CRM if you'd like.
Okay, let's go over CRM. Awesome.
So the quarter, I
It's a
actually thought it was
disaster. It became
good.
a super hated stock.
Yes.
No one likes a stock.
Yeah. Current consensus.
Can
is
you
that
tell me? Can you name it? Can you name me 3 hated stocks that nobody likes? Like
Salesforce?
whatever they report, because I've seen a lot of stocks out there. They post good reports, they up guide and stuff like that, and the dips aren't bucked. If they happen to go up, the rips, get faded. So can you name three stocks that you can tell like, wow,
I
these
could name.
are
I could name
hated
three
stocks?
other than Salesforce. I would say Stanley Black and Decker is one of them. Pfizer is another one.
Yeah, Pfizer
And
is a super hated
the,
stock.
the poster
It's a
child.
hated. I have another one.
The poster child is Adobe.
Oh yeah, that's.
That's the poster child.
Oh yeah, it's a super hated stock. What about let me see. I have one in my mind now. I forgot it. I mean, it's a semiconductor stock. The stock, the company that is selling chips to Apple.
Qualcomm.
Qualcomm. How about that?
Right?
That's a super hated stock, regardless of whatever Qualcomm does. Another hated stock, DocuSign. Another hated stock, Zoom. They hate Zoom.
Actually, I haven't looked at Qualcomm stock in a while. I might be wrong.
No, it's a disaster.
Oh, no, it's not. Yeah, it doesn't look great. It doesn't.
Guys, please never buy Zoom, DocuSign, Salesforce, or Qualcomm, and you're gonna be fine. And Pfizer.
And Pfizer, stay away from that.
There
I only lost 5% there. Thank God.
Okay, CRM. Would you buy the SIP?
No. Current consensus.
I didn't take a look at the report, so I don't know.
Let me talk a little about the report. So current consensus is that Salesforce's per seat model just isn't suited for the environment. AI is promising or threatening to shrink the workforce and the headcount at companies. And if you're asking companies to pay you per seat per employee, this trend doesn't go well for you. Even if you remove the AI threat, the economy in and of itself with, payrolls, we could get a headline number below 100,000. It just doesn't bode well for a company that relies on business formation. That said, the quarter was solid, but I think the reason it got sold is because the guidance didn't mesh with the commentary. During the call, Benioff stated or made the argument that their agentic AI business, their agent force, is working. And I can see that there is monetization happening. They are reporting revenue associated with Agentforce. But if that segment were really booming and going on all cylinders like Benioff said, then that leads me to ask the question, why would your forward guidance be so conservative? So you can't tell people on the earnings call that your AI business is great and then drop a conservative guidance. Those two things are conflicting.
Even though the stock is like way off all-time highs, way off.
In my opinion, this is a prove it stock. And someone
it's
in your
33% off the highs. And despite the fact that this stock has been going down a lot, would you say that the report was decent?
Yeah, no, I thought the report was good. The problem is that...
But the stock didn't do anything. Yeah,
the problem is that when
there's no momentum.
The problem is that when you tell your investors that your AI business is working and that is going to insulate you from AI workforce reduction, and then your guidance doesn't reflect your optimism in AI or in agentic AI.
Yeah, there was a contradiction there.
Yeah, you're going to sell the stock. And I want to say this because someone in your Discord asked me about this stock came up, and I told him that you just need to wait for the stock, the narrative, and the price action to change before you do anything. And I still feel that way. But after reviewing the quarter and sitting on it for a little bit, I feel as though we're probably closer to the end of this drawdown than the beginning. But until Salesforce and Benioff come out and convince the market that they are going to be able to change their business model from relying on per seat to a consumption or agentic AI business model, it's just not worth putting money to work here. There's better software names.
And the technical chart validates what you're saying. This is a major downtrend below all the moving averages. Take a look at how Salesforce couldn't burst above today the 20-day moving average. So this is not a buy the dip opportunity, by any stretch of the imagination. I would wait until buyers show up here and maybe, show a bit of strength, maybe by recapturing the 100-day moving average, which is signaling as of now to $162. A very ugly looking chart. So yeah, I mean, the net aggregate opinion of the markets is validating what you're saying. So no one is expecting something positive out of Salesforce, at least in the short term. And the technical chart is basically reflecting that, right?
Right. I
have a good one for you. So did you know that the CEO, Mark Benioff,
yes,
he went on the air last night with Kramer on Mad Money.
He always does that after a quarter, yeah.
Correct, exactly. Mm-hmm. It's like a tradition or something. And he got in a fight with Kramer.
Of course he.
Yeah, and he said that they are a better company than Palantir.
Yeah, well, sure.
Do you think that's a joke? I mean, it's a cheaper company than Palantir, but I wouldn't buy.
Cheaper for a reason, I would say.
Yeah, I mean, yeah. So you, where would you buy the dip? Say that you were interested in maybe.
You need to see buyers come in. If you pull that chart back up, you could make an argument that assuming there's no more downside from here, CRM just made a higher low. So I would honestly wait until you see a higher high. I am of the opinion that if the market is wrong and has been wrong to punish Salesforce like this, then there is going to be a lot of upside, and I do not need to get in on the first leg to make money in the name if it is something I want to do.
The chart looks extremely awful. And if this support breaks 226-ish, wow, there's a lot of room to the downside here. So, and this is not a cheap stock, by the way, bro. If we take a look at the multiples, so it's a software company. Most software companies trades with high valuations and expensive valuations. So yeah, I mean, I would be patient here, and I wouldn't try to be a hero. And as we always say in Discord, Dan, so don't buy the dip, buy strength after the dip. So if you are interested in Salesforce, just be patient and wait until others do the hard job of finding out where the bottom is located at. And be patient. In my opinion, this is a no touch below $161.
Until it makes a higher high, it's a falling knife. The last thing I want to say about Salesforce. You mentioned that typically speaking, software companies have higher valuations, and that's true because software companies, generally speaking, have the capability to be secular. They don't rely on the underlying economy. They're not cyclical. As I mentioned earlier, right now the market views Salesforce as a headcount, payrolls, business formation story, which means that Salesforce is a cyclical company, so it doesn't deserve a higher valuation. And until Salesforce can prove that narrative incorrect, this is going to be a very challenging stock to be in, and I don't think you should die on this hill.
I have to take back what I just said. It is no longer an expensive stock. So we had a very interesting multiple compression here. This stock is trading at its lowest forward P ratio ever, 20.
10 years on the, max.
So that's, okay. This is a lot, man. I mean, the question is, have the markets priced in enough bad news at a forward P ratio of 20? I don't know. I am not willing to find it out, but So I'll put it on my watch list. Let's just put it that way.
I like that. There's one more knife to drop here. Once Salesforce shows up in the value investing subreddit, wait for the next 10-20% drop, then you can start buying it.
The company, the markets are very negative about the future of this company. Now take a look. Yeah. Revenue growth looks very healthy, 10% year-over-year revenue growth, $1.8 billion of net income. Wow.
That is very interesting because you wouldn't expect that kind of revenue growth if the company is truly tied to payrolls and headcount.
Correct. In these cases, when I see a company trading at with a low valuation relative to its
a software company,
most recent past, correct.
This is low.
Correct. But On the other side, we have the technical chart. So we have the net aggregate opinion of the markets, which is telling us that it is trading, as you just pointed out. It is trading with a cheap valuation, maybe for a good reason. So be careful, guys. Yeah. But the valuation suggests that maybe it might be, bottoming out, soon, maybe. Wait until buyers show up.
I'm not dying or buying on this hill. So
okay,
let's move on to Figma.
There you go. Let's. I mean, I don't know anything about that stock, so
sure. So a little bit of a background here. Before it came public in July at a $19.3 billion valuation, Adobe tried to buy them for $20 billion in September 2022.
Oh, is this a company like a website to design stuff?
So the deal got blocked, and it was thought to be synergistic in nature. Without getting too in the weeds about it, Figma is effectively the Adobe standard for creating, testing, and sharing designs for websites and apps. I've never used it, but the way it's been described to me is to think of it like a Google Drive, where developers can work together on designs for websites and apps in real time. Like if you and I were to hop into a Google Doc, you could work on it and I could work on it at the same time. We could see each other working on it together. It's that, but for websites and applications.
Gotcha.
In my opinion,
but this thing went up to $152. We had a bit of a IPO bubble, right? Like 2 or 3 months ago. So Circle went on a tear, and CurveWave went on a tear, and this stock as well. This thing went up to $150. Now it is trading at $54. Yeah,
that's a great observation. And before we talk a little bit about why this company specifically is in trouble, because the quarter itself actually wasn't that bad. EPS break even, rev and guidance were a beat. Insiders even agreed to extend their lockup period, so they have to hold the stock longer. In my opinion, that leads me to believe that similar to Adobe, the concern is AI disruption. Many are wondering what moats and barriers to entry exist in a world where AI is already catalyzing a proliferation of upstarts in the design, art, and website creation space. And they're undercutting the incumbents by doing it at a lower price, and in some cases more attractive features and solutions. There isn't anything particularly sticky about Figma's ecosystem, and while management is in the process of implementing AI features, they aren't charging for them yet. So in my opinion, the reason for the down 15% response despite what appeared to be a really good quarter across the board is that the market just doesn't believe that this company has a moat.
Gotcha. I mean, take a look at the technical chart. Doesn't look good at all. This is a major downtrend below the 20 and the 5-day moving average, which are the only two moving averages that we can use because this stock started trading not long ago. Yeah, I mean, this chart looks horrible, man.
So go ahead. You mentioned this. We had a bit of an IPO bubble. Typically, when we have a market bubble, IPO market is on fire.
That is right.
Right. So how do I put this? There's just euphoria in everything IPO. The window opens and then it gets blown off from the house. We're talking like hundreds of IPOs a week. Each one doubles or triples on the first day, then doubles and triples again without any reason. When they report earnings, no matter what they say, people buy the report. In short, every time you hit the buy button, you make money immediately. And that just hasn't been the case with this class of IPOs. And I just want to, do you mind if I take the screen real quick?
Speaking of a bubble, take a look at this, bro.
So do you mind if I go?
Yeah, sure. But let me show you something.
Oh, go ahead.
That kind of validates my idea that we were in some sort of of IPO bubble. This stock was supposed to start trading at $23. It opened on July 31st at $83. Unbelievable.
Doubled its market cap in a minute. Yeah.
Unbelievable. It went up to $150, and now the technical chart is absolutely broken. So again, as we just pointed out in the case of Salesforce, don't buy the dip, buy strength after the dip. You guys got to wait until buyers show up and start showing strength. So at least wait until the 20-day moving average is recaptured, $74 and stuff like that. While this stock remains trading below the 20 and the 5 DMA, lower prices can keep coming for FIG. Go ahead, bro.
Yeah, no. I'm happy you did that. Here, let me show you. Let me pull up this chart before we do it here. Okay.
We have
So,
5 more minutes for the challenge.
well, I think
We're good.
We're moving on. We're moving on.
It's a
Entire
challenge, so
window.
it is supposed to be challenging.
So here's CoreWeave. This topped topped on my birthday, June 20th. Look at that.
There you go.
But after having an absolute boom over 3 months after its IPO, this is just straight down. Recently made a new low. This is a do not touch. Another one, bullish. Everyone was super happy about this. This
What a
chart doesn't
disaster.
show you much.
What a disaster. That's a crypto exchange, I think.
Opened high, came low, no rebound, just on its way down. Sorry, these charts aren't super impactful because these things, bullish IPO'd literally 2 weeks ago. Circle, to your point, 1 year.
All of them.
All of
So
them
every
down
single
to the right.
IPO that we had recently is like way, way, way off the highs. It was a bubble.
Right.
It just popped. It is what it
Exactly.
is.
So my question is then, how can we be having a market-wide bubble if this is the 3-month price performance or since IPO of 4 of the hottest new hot tech stocks in the market? There's no bubble here.
Or maybe the bubble is starting to pop with the, like with the craziest, stocks out there. And maybe Nvidia and Palantir are coming up next. I am wearing my suit here.
No. You're fine. I'm just saying. I'm just trying to make the point.
I get your point. You're making a very good point. So this.
I don't know about you, but have you?
We shouldn't be speaking about us. With these stocks going down like this, it's either we are not in a bubble or the bubble started to pop with these stocks.
Or now call me crazy. The market's not stupid. It's differentiating between who's succeeding and who's failing.
Which is the case of AVGO. AVGO just reported $16 billion of revenue.
I'm not
and they
familiar
made
with that
$7
company.
billion.
Broadcom. You said
AVGO.
AVGO. Oh,
AVGO,
sorry.
correct.
Of course.
Or AVGO,
Avago
people
or whatever,
pronunciate Avago, whatever it is.
Sorry.
So Broadcom, they just reported $16 billion of revenue, out of which $7 billion came entirely from free cash flow. It's insane.
It's a great conversion rate.
It's crazy. Crazy stuff. We're going to be making this up. As simple as that.
I think the only real bear case, and it's not even like a bubble popping bear case, it's just here's what might cause a 10 to 15% correction in the S&P, and I don't know when it happens. I don't think it happens this year.
We're rooting for a correction, but
sure,
it doesn't come.
Sorry, let me rephrase that. I'm not saying we won't get a 10 to 15% correction this year,
which eventually we will get. Not this year, but eventually.
Well, no. It could happen. What I'm saying is the thesis I'm about to lay out, the bear case I'm about to lay out, I wouldn't expect to happen until the beginning of next year, maybe even halfway through. Right now, based on everything we've seen from the hyperscalers, we know there is a huge CapEx spend going on in the data
which
center.
is fueling the economy.
100%.
100%.
There is going to be a transition period between that money being put to work and that money showing you a real return on investment. So I expect there will be a shaky 1 to 2 quarter period where we stop spending like mad because we think that we've built enough or we don't need to build as much as quickly. But
profits start to catch up relative to the investments, right? So
the profits will catch up, but there will be a period between when we stop spending so much and the profits catching up. And
Correct.
That would be not ideal, but the perfect storm for a 10 to 15% correction.
Correct. There you go. So you are not a Figma buyer anytime soon, I guess, right?
I think the only people buying Figma are the people that are buying Adobe.
Good luck with that.
It's not going to work.
Probably so. There you go.
The good news is that maybe if you see it fall below 33 and you see it at 20 billion, maybe Adobe
What's the market cap of this thing? Oh, $33 billion. Oh my God. It trades at at least they are about to make a profit because they have a forward P ratio, 112. So, the analysts are expecting this company to start making a profit at least within the next 12 months. And when we have a price as of 37, no thanks. I am not a buyer of this dip.
No,
Thanks,
there's no reason.
Thanks for now. Good luck. Hey, 40 minutes. We did it.
40 minutes done.
Yeah,
and
mission accomplished.
Mission
Hey,
accomplished.
drop a comment down below, guys. Do you
Yes,
like
please.
the pods? Our podcast, it'll be somewhere around 35, 40 minutes, 45 minutes. Are you guys down for another live podcast? I am down, bro.
Yeah, yeah.
I am
Maybe we might need to find. It would need to be a weekday this month. I am crushed on the weekends, so
Okay.
I'll be out of town most weekends. But
That's okay. But
Mm-hmm.
maybe next Thursday we can do a live pod.
yeah, we could definitely do a live pod
That-
next Thursday.
That
for
should
sure.
be super fun.
So-
So,
Yeah, no. Drop us a comment. Let us know what you want to talk about. Like, follow, subscribe.
our links, our links are
gonna
in
be
the
down there.
description
Follow
box.
my blog, GorillaWGlasses.com.
Our Patreon and stuff. Correct.
And we look
There you go.
forward to seeing you next week.
Absolutely.
Goodbye now.